you could save $500 per month on the first year of your mortgage. Okay, you've heard it on the street, seen it in news articles, or maybe just not heard about it at all. The infamous 3-2-1 loans that are exploding onto the scene with force here in 2022 and going into 2023. What are they? What are the risks? What are the rewards? The good, the bad, the ugly, the things that you don't see or hear in the marketing materials because they are marketing materials. They want you to buy all the things of the 3-2-1 buy down. Let's dive into exactly that. First, we're going to start out with a little bit of a history lesson, and you know I love history. Buying the rate down on a mortgage is not a new thing. Ask your parents. I had to ask mine. In the early 80s, when interest rates went all the way up to 18%, there were only like 2 real ways to get a home sold. Well, actually, there were 3. Either sell it on land contract, and as a seller, that's hard because you still have that mortgage payment that you're technically responsible for. If you have a mortgage on the home, it just sat there until the buyer could refinance out, and until then, you became the bank. As a buyer, you had that seller in your life, and like I said in the Sandlot, it felt like forever. Or at least it felt like it. The second way was to buy down the interest rate. So you can pay points to buy down the interest rate to something reasonable and affordable like 14%. And yep, back then 14% was considered affordable. This sounds insane just coming out of my mouth. Third way, of course, is burn down the house, take the insurance money. Do not do that. Do not do that. Also, you're not gonna hear me say anything like 6.5% rate. Back in my day, the rate was some other number and I had to walk uphill to school both ways in 7 feet of snow, and I had to put the smaller children up on my shoulders and carry them or they get lost in the snowdrifts, never to be seen from again. I'm not that guy, you know this. 6.5 is a high rate. It's a really high interest rate. That's what it is right now, and it's high. I'm a realtor. I went and I said it. The board of realtors is gonna kick me out now because we're not supposed to say stuff like that. But hey, I am one to throw caution to the wind every once in a while. I'm a 90s kid and we didn't wear helmets riding bikes. What I am is Mike Perna, the real estate guy here in Metro Detroit. If you're considering buying or selling, scope out our reviews, give us a call. Also check out our other socials, our Instagrams, our TikToks, and all those wonderful things for funny content on all things real estate and Metro Detroit happenings. Okay, the 3-2-1 buy down has been gaining a lot of attention lately, and I'm gonna give you the skinny as I always do. Marketers make it out, as they should, like everything is sunshine and rainbows because that's their job. And like all things, there are definitely some pros and definitely a bunch of cons with this one. First, what is it? It's simply a loan that charges lower interest rate for the first 3 years. The 3 is where a buyer is gonna be charged 3% less on the interest rate on the mortgage in the first year, 2 for the second year, and then 1% less than the rate of the day for the last year. As of the making of this video, rates are 6.5%, so the first year your rate would be 3.5 with this loan, then 4.5, lastly 5.5, and in the fourth year back to the full 6.5. The pro, clearly, is that you're gonna have a cheaper payment for the first couple of years. So working on some real numbers, the average home sale in Metro Detroit is roughly $300,000. Putting 10% down, the loan amount is about $270,000. Using the average tax rates and insurance rates in Michigan, the payment all in at a 6.5% interest rate is gonna be about $2,180 per month. Subject, of course, to the insurance and tax fluctuations depending on the community and all those other things. If you did a 3-2-1 buy down, adjusting the interest rate for the first year to 3.5%, that total payment would now only be $1,692. That's a change of $488 per month. See where I got the hook from the start of the video? Pay $500 less per month for the mortgage, right there. Year 2, it goes up to 4.5%. You're also gonna see that payment raised to $1,848 per month. And year 3, when it goes to 5.5, you're gonna have a $2,013 per month payment, $2,013 per month payment. And finally in year 4, you're back to the original rate of 6.5%, so that's $2,180 per month. Total saved over the 3 years is $11,844, and that is a heck of a lot of money. So that's the actual major pro. It sounds awesome, and it's a great marketing pitch, and here are the cons that they don't tell you at first. First and foremost, it ain't free. They're not just gonna give you the better part of $12,000. It comes with an upfront cost. And really, the upfront cost is the $11,800 that you would have paid over time in the loan. You're just paying it at the start of the loan to bring your monthly payment down. Now, we've done a great job for buyers in this market, getting sellers to contribute some of or all of this during negotiation. But first off, that's not guaranteed. Number 2, often we can negotiate the same or similar off the price, so it becomes 6 of one, half dozen of another. You're really just putting that right back in your mortgage anyway. You need to know that. Instead of doing the 3-2-1 loan for a cost of $10,000 or $11,000, ask how much it would be to permanently buy down your interest rate. As of filming this video and subject to change, of course, that same $10K, you can buy down the rate 1% on the loan from a 6.5 to a 5.5. If interest rates go to 7%, then it would go to 7 to a 6 or 6 to a 5, but it would be permanent. Now the break even on that is 5.3 years. So if you're gonna be in the home for over 5.3 years and you don't see rates moving down past 5.5, you're better off just buying it down permanently than a graduated rate buy down moving back up. If your intended use of the property in the future is to rent it out, it's worth considering because interest rates will come down, but we have no idea how much and we have no idea when. I predict end of 2023 we're going to see that start moving down, but hey, who knew they were going to be 7% from January to now? Here's a great calculator to fiddle around with as well, and a link to it in the comments. I love the switch to plain English feature on this specific calculator, guys. All right, here's the third con, and this comes from boots on the ground, talking to a lot of people. I know consumer behavior, and I'm gonna be upfront. I know my own behavior. How many people would take this $600 or $500 per month savings, which by the way, you paid for upfront, and then go and invest it into a 401k, an SEP, a Roth IRA, a kid savings account, all of it. Especially now with the inflation rates so high, most people, I'm not saying all, maybe not you, but most definitely me, they're gonna let their monthly expenses balloon and expand into whatever their take home is. This extra $500, generally speaking, is not going into savings and investments, it's going to non-essentials like eating out or buying stuff, and then in year 2 your payment goes up $200 and you've adjusted to that lifestyle and you're either cutting your budget or adding credit card debt to cover that spread. Now hopefully you'll get wage increases, you'll get raises essentially at or higher than the difference yearly, so at or higher in this case than $2,400 a year. In fact, the majority of us based on wage increases over the last 5 years will, but again, that's not guaranteed. The payment going up in fact is guaranteed with this loan. It might be more prudent just to get a home with a $1,700 a month payment for the start, or $1,900 you can buy down with that $10K. And I know it's adjusting the expectations down, it's buying a little bit less of a home than you want, but that may be the actual most prudent thing to do. The last thing I want to do as someone who empowers people through education and home ownership is for home ownership to be a stress. This should be a wealth building, memory making, and tax savings vehicle, not to add a stress to your life other than of course the weekly honey-do list, and I just can't help you there. Last one, and this is being marketed as a pro, but I think it's actually a con. Right now, this is being marketed as interest rates are gonna be lower before it expires and you get back all the way up to that 6.5% or 7% rate. Now on this one, people are saying things like date the rate, marry the house. And I and no one else out there can guarantee that rates will be low, or how low, or by how much, or when it's gonna happen. I believe they will. I think we're gonna see a 4 or 5 to a 5% interest rate in 2024. And frankly, that means a 2-1 buy down is probably a better option for most people, but there's no guarantee it will happen, when it will happen, or by how much. So we've talked about some pros, a couple years with lower payments, and also some cons. Ultimately, I think everybody just wants to know, is this a good deal for me? Should I do it? Now, if it's a seller that's super aggressive on getting their home sold and they're already offering it, or if it's a builder that's using it as a builder incentive, guys, take the money. Take the money. Let's take it. It's not costing you. If you're paying for it, I personally would not do it because I don't see a guaranteed win for it. No guarantee I get my money's worth. Because honestly, guys, if interest rates go down 2 points next week, you're just gonna refinance the loan and you've lost that 10K. They're not giving it back. I'd rather see you work with a loan professional to look at all 3 scenarios. A permanent buy down, this, or frankly taking the 10 to 12K and putting into a good old-fashioned S&P 500 fund, Russell 3000 fund, while the market is down and you still have the money available. In a pinch, should you need it, you can sell those shares, pull it back out. If we can help you out at all, give us a call, shoot us a text, shoot us an email, or head over to pernateam.com, fill out the form, and I'll call you immediately and provide you the best experience you've ever had in a real estate transaction. Subscribe, and if you've gotten some value from this, please hit the like button. I truly appreciate it, and I'll see you on the next video.